What is the definition of return on investment? We're going to answer that question in this video. Okay, let's rock. If you like money, listen up and make sure you watch this entire video because I'm here to stimulate your mind and help you understand money better and how to grow it. Okay, so return on investment. Let's talk about that for a second. So you have a pile of money and you want to invest it. That's what we're talking about here. So you're going to take that money and you're going to invest it somewhere. And what's the number one rule of investing money? I think Warren Buffett and all these guys said it. Don't lose money. My father always said, don't lose your principal. And what they mean by it, the principal is that money that you're going to take over and try to invest. Don't lose that money. That's the key. So risk in investments is everything. Generally, the lower the risk, the lower the return. The greater the risk, the higher the return. So it's the whole thing, no pain, no gain, right? High risk, high reward, low risk, low reward. It's very rare that you find an investment that has a low risk with high interest or a high return. Okay, so you need to know that. So return on investment is your goal is you're going to invest a bunch of money that you've worked your tail off your entire life to save. You've already paid your taxes on this money. You know, you had all your living expenses, you had unforeseen expenses come up, and then you have what's left over. That's your investment money. And you're like, this is what I can afford to invest after my savings, and hopefully I can hit a home run or hopefully I can do really well. Well, the goal, one of my best mentors always told me, slow and steady growth. So if you're not going to lose your money, if the goal is not to lose your principal investment, this pile of money that you're going to invest, don't go with super high risk, okay? If you're young, there's a lot of people that'll argue, take all the risk when you're young. And I'll tell you what, I did that. But I don't want to give investment advice and tell people you should go into all the high risk stuff when you're young, because in most cases, you're going to lose your money. I'm telling you. So heed caution, beware. If you're going to go into a lot of high risk, you're going to probably lose a lot of money doing that. But what happens is you end up hitting on one and it becomes addictive. And you're like, oh my gosh, you know, I invested $1,000 and it's 10,000 now. And you're so excited because you 10 extra money, but you might have lost a lot of other investments making those same kind of decisions. So a lot of people that decide to take high risk, they do it because they place that $1,000 investment 10 times. And they say, well, as long as I'm right 1 out of 10 times, then I break even. If I can be right 2 out of 10 times, I make money. But slow and steady growth from one of my key mentors in my life is what gets you wealthy over time. So you really only need to average 6, 7, 8% on average per year on your investments to roughly double your money in 10 years. Now let's talk about this. The rule of 72, write that one down. This is a big one. The rule of 72 is how you do the math calculation on how to double your money over the course of time based off the interest rate that you're getting. Okay, so let's stop and pause and just take that all in. Feel free to pause the video if you need to. The rule of 72 basically is a number where you're going to take the interest rate that you're earning on the investment that you made divided by 72 is going to tell you how many years it will take to double that money based off of that interest rate. So let's make it super easy, super easy. If you could earn on average 7.2% return on your money consistently year after year after year, it'll take 10 years to double your money. Now, what you have to take into consideration are things like inflation, because inflation, what that means is as time goes, it'll actually cost more money, more dollars or whatever your currency is. It'll cost more dollars to buy the same thing. Just as an example, let's just say inflation set in on a gallon of milk. And let's say a gallon of milk was $1. Maybe after an entire year, there was 5% inflation. So that same gallon of milk might cost $1.05 next year. So it takes more money to buy the same item. That's inflation. So you want to make sure that when you're investing, that you're at least beating inflation. Now they'll advertise, you know, all the financial reports will say, we've had 2% inflation or we've had 3% inflation, whatever it is. Just if you figure 2 or 3%, that gives you a good idea of what you need to keep up with just to be able to afford to buy the same things that you did the previous year. So if you can make 7%, say 7.2 like we were talking about, and inflation is, 2.2%, then you're really only netting 5%. You got to understand how that works. Now, compounded interest, if you leave your investment alone, let's say you have it in like an IRA or a long-term mutual fund, or you bought an index, or you have an investment property, you bought rentals or something, and you're making 10% return on your money, something like that, or 15 or 20%. Some can make even more. Well, that inflation that's going to happen over time is, if you're making a higher interest rate, is going to be a lot easier to deal with than if you were making a lower interest rate, right? But again, some of those might be a higher risk or something like that. So if you want to learn how to grow money, once you become good at making money in your business, or even you might have just work for a big company and just make a great salary, you've been employed for a while, you might manage a company that does hundreds of millions of dollars a year in annual revenue or billions, and you're watching this saying, yeah, I already do that. I already stick that. So you know the rule of 72 if you're that person. You've understood it. And then when you get to that level, you have to decide which investments are the best places to put your money. And what's interesting is you see this about every 7 to 10 years, is you'll see a market go into a bull market. What they mean by a bull market's when a market just keeps going up like every single month, every year, time after time. It's the bull. A bear market's when it's consistently going down. So the bull is up and the bear is down. Well, if you're in a bull market, let's say the stock market, we just had 10, 11, 12, 13 years, however many years it's been, of a bull market for the stock market. That sucker just kept going up and up and up every year and built this bubble where everybody that was even investing in the stock market, even the best analysts, were saying the bubble's got to burst. We're going to have a correction. It's going to have to drop. It's going to have to tank. And it took the whole COVID-19 situation for that to really, the straw that broke the camel's back. That's what really started and triggered the stock market to start collapsing. And it went down a lot by like a third. But what's ironic is there's other industries that prospered significantly off of that drop. And ironically, it was not precious metals. We thought that if the stock market crashes, holy cow, gold and silver and precious metals are going to go up. Oil's going to go up. Nope, those went down too. And there was a lot of other industries that followed suit and did the same thing. But I'm in the collectibles industry. And what was ironic was, with all of these markets basically collapsing, we noticed that out of nowhere, all the collectibles, the high-end stuff, the mid-range stuff, even some of the low-end stuff, those all started going up a bunch. And people have asked me, why? Why did all these old Pokemon cards, baseball cards, comic books, Magic the Gathering, depends on what it was, why did a lot of this stuff start inflating in price? And I said, the only thing that makes the easiest sense to me is the money that was in the stock market, a lot of people cashed out, which is what made it tank, right? What made it drop is people were selling. So when there's more sellers than buyers, prices drop, supply and demand. So there was less of a demand for the stock market and the stocks, so the prices drop. Well, they took that money and they're either sitting on the sidelines with their cash, or they're putting it in other things. And what we seemed to notice was one of two things happened. One, a lot of those people wanted to have tangible high-end items. Even they were buying, say, graded diamonds or things like that, high-end diamonds or whatever. So they wanted to have something they could physically touch, something they could hold in their hand, not something that was on a computer screen where it said they had this much money. They wanted to touch it. So either A, they put that money into those collectibles, or B, maybe it was the fact that the government pumped trillions of dollars into the system. Trillions of dollars of government bailout money with nothing to back it up. It's not like they had gold to back it up. They went out and bought gold and produced these dollars. They just printed the money. They just sent everybody tons of stimulus money. Well, when you send and you inflate and you push a lot of money into an economy, into a market, now there's more cash. Well, there's nothing to back it up, so inflation sets in. And so that's what happened, in my opinion. I think we saw a lot of this money, a lot of influx of this stimulus money come in, and a lot of people were spending it on their collectibles and things like that. And so those markets actually pumped up. So if you know anything, and I'll use Pokemon as an example, the prices of Pokemon cards in the last couple months, which ironically is when the whole lockdown, government shutdowns happened here in the United States, all went up. Some of them went up 30%, 50%, some of them doubled, some went up more. But the bottom line is stuff went up. So anyway, what's a different definition of return on investment? I hope you understand that by the end of this video, and that is getting an interest rate, getting a quote unquote return. So the interest rate is really the return for your money for investing that money. And remember, if you're going to invest, do your due diligence, talk to your financial advisor, talk to your friends, talk to people in the industry. Before you make a big move, there's no reason not to take your time and make sure you know what you're doing. So that way you don't do what? Lose your principal. Don't lose that pile of cash. That's the cardinal rule of investing. Do not lose money. So anyway, I hope you guys found this valuable. If you like the video, please click the subscribe button. I'm going to continue to deliver. And remember, keep pushing hard, and be the hustler.